Overconfidence is one of the most destructive psychological traps in investing, defined as the belief that you understand the market better than you actually do, or that your decisions are more skill-based than luck-based. This is not arrogance. It is a cognitive bias that affects even experienced investors. When people feel in control, they trade more frequently, ignore warning signs, and dismiss contrary evidence, all while believing they are being proactive. The market, however, does not care about confidence. It only responds to probabilities, risk exposure, and behavioral discipline. Overconfident investors consistently underperform because they mistake volatility for opportunity and randomness for mastery. The illusion of control is especially dangerous because it feels productive. Making frequent trades, adjusting positions based on gut feelings, or believing you can time the top creates a false sense of agency. In reality, markets are complex adaptive systems influenced by millions of variables: economic data, geopolitical events, algorithmic flows, sentiment shifts, none of which any single investor can predict or control. What you can control is your process, your entry criteria, your position sizing, your risk limits, and your exit rules. Everything else is noise. Mistaking noise for signal is where portfolios begin to bleed. Overconfidence often stems from early wins, especially in bull markets. A few successful trades during a rising tide can create the illusion of genius. But in strong markets, even poorly constructed portfolios can generate returns. The real test comes during corrections, volatility, or sideways markets, when skill, not luck, determines survival. Investors who attribute early gains to skill, rather than favorable conditions, set themselves up for catastrophic losses when conditions change. The market does not punish ignorance. It punishes the belief that you have outsmarted it. Data from Dalbar and other behavioral finance studies consistently show that the average investor underperforms market benchmarks by wide margins, not because of poor strategy, but because of poor behavior. Overconfident investors chase performance, rotate in and out of assets at the wrong times, and abandon long-term plans during short-term stress. This behavior gap, the difference between what the market returns and what the investor actually earns, is directly tied to emotional overreach and the illusion of predictive power. You do not need to predict the market to succeed in it. You need to manage yourself within it. A practical way to combat overconfidence is to maintain an investment journal. Record every decision, why you entered, what your thesis was, what metrics you used, and what your expected outcome was. Review it quarterly, not to celebrate wins, but to audit errors. Did your reasoning hold? Were your assumptions valid? Did external factors invalidate your thesis? Or did you simply get lucky? This practice forces humility. It transforms subjective confidence into objective measurement. And over time, it reveals patterns not of market behavior, but of your own behavioral weaknesses. Another antidote is benchmarking. Compare your returns not to your neighbor's hot stock tip, but to relevant indices or passive strategies over 3, 5, and 10-year periods. If you are taking active risk, you should be generating active returns, net of fees, taxes, and transaction costs. Most do not. And when they see the gap, overconfidence begins to crack. That is not failure, that is the first step toward real improvement. Admitting you are underperforming is uncomfortable, but it is infinitely less costly than pretending you are winning while bleeding capital. Overconfidence also manifests in portfolio concentration. Believing you have figured out one stock, sector, or asset class leads investors to overweight it, sometimes to the point of risking their entire portfolio on a single outcome. Diversification is not just about spreading money, it is about acknowledging uncertainty. No one knows which company will dominate in 10 years, which sector will collapse, or which black swan will emerge. Concentration is a bet on certainty. Diversification is an admission that the future is unknown, and that is the only rational starting point. Technology has amplified overconfidence. With real-time data, instant trades, and endless commentary at your fingertips, investors feel more informed than ever. But information is not insight. Access to data does not make you smarter. It makes you more reactive. Algorithms trade milliseconds. You cannot compete with that. What you can do is slow down, build checklists, require cooling-off periods before major trades. Force yourself to write a one-page thesis before entering any position. These friction points disrupt the illusion of control and reintroduce deliberation. The most dangerous form of overconfidence is believing you are immune to it. I am disciplined. I stick to my plan. I am not emotional. These are the last words spoken before a portfolio blow-up. Behavioral biases do not announce themselves. They operate silently, disguised as logic. The only defense is structure, automated rebalancing, hard stop-loss rules, third-party accountability, and predefined allocation bands. Systems beat willpower. Always. If your strategy relies on staying calm during a crash, it is already flawed. Assume you will not be calm and build guardrails for that reality. Ultimately, overconfidence is not about ego. It is about misjudging the nature of the game. Investing is not a test of intelligence or prediction. It is a test of patience, process, and self-awareness. The market does not reward brilliance, it rewards consistency. The most successful investors are not the ones who know the most, they are the ones who know their limits. They trade less, document more, measure honestly, and adjust without drama. They accept that control is an illusion, and build systems that thrive within that truth. That is not weakness. That is the foundation of long-term wealth. Emotions are not occasional intruders in investing. They are constant, silent partners in every decision, whether you acknowledge them or not. Fear, greed, hope, regret, envy. These are not flaws in your personality. They are evolutionary responses wired into your brain. The market does not care. It exploits them. Emotional trading is not a lapse in discipline. It is the default human condition. The only way to succeed is to design systems that bypass emotion entirely, because willpower alone will always fail under stress. Fear triggers panic selling. When markets drop, portfolios shrink, and headlines scream, crash. The instinct is to sell, to stop the bleeding. But selling during a downturn locks in losses and removes any chance of recovery. Historically, the biggest gains follow the biggest drops, but emotionally compromised investors are not there to capture them. They have already exited. Greed, on the other hand, fuels buying at peaks, chasing the next big thing, after it has already risen, driven by FOMO and social proof. Both behaviors are mirror images of the same error, reacting to price movement instead of valuation. The behavior gap, the difference between fund returns and investor returns, is almost entirely caused by emotional timing. A mutual fund might return 8% annually over a decade, but the average investor in that fund earns only 4% because they bought after rallies and sold during corrections. They did not lose money because the strategy failed, they lost money because their behavior failed. This gap is not a market problem. It is a human problem. And it is avoidable not by becoming emotionless, but by removing emotion from the decision loop. One of the most effective tools against emotional trading is automation. Set up automatic contributions, automatic rebalancing, and automatic tax loss harvesting. If your money moves without you having to decide, you remove the moment of emotional vulnerability. You do not have to be brave during a crash if your portfolio is already rebalanced by algorithm. You do not have to resist FOMO if your allocation bands prevent overexposure. Automation does not make you smarter, it makes you irrelevant to your own worst impulses. Another critical defense is pre-commitment. Before you enter any investment, define your exit conditions not based on how you will feel, but based on objective metrics, price targets, trailing stops, time horizons, fundamental deterioration. Write them down. Sign them. Share them with someone who will hold you accountable. When emotions flare, you do not debate, you execute the plan. The moment you start improvising during volatility is the moment you guarantee underperformance. Your future self will thank you for binding your present self to rules. Media amplifies emotional trading. 24/7 financial news, social media gurus, and algorithm-driven fear headlines are designed to trigger reactions, because reactions drive clicks, views, and engagement. None of it is designed to make you wealthier. Turn it off. Unsubscribe. Mute keywords. You do not need real-time updates to build wealth, you need consistency. The most successful investors are often the least informed in the short term, because they are not distracted by noise. They focus on the plan, not the panic. Social comparison is another emotional trap. Seeing friends, influencers, or strangers post about their 1000% gains triggers envy and urgency, leading to impulsive bets on meme stocks, crypto, or speculative assets. But you never see the full picture: the losses, the leverage, the sleepless nights, the blown-up accounts. Comparison is not just demoralizing, it is financially hazardous. Your journey is not theirs. Your risk tolerance, goals, and time horizon are unique. Chasing someone else's win is the fastest way to create your own loss. Regret is a silent portfolio killer. Investors who sold during a crash and missed the recovery often refuse to re-enter the market, paralyzed by the fear of buying high again. Others hold on to losing positions for years, hoping to get back to even, ignoring that sunk costs are irrelevant. The market does not care what you paid. It only cares about future value. Letting regret dictate your next move ensures you are always fighting the last war, not preparing for the next opportunity. The past is data. The future is probability. Act accordingly. Creating emotional distance is not about detachment, it is about structure. Use checklists. Require 48-hour cooling periods before major trades. Assign percentage limits to speculative positions. Never make decisions when markets are open and volatile. Schedule portfolio reviews quarterly, not daily. These rules are not restrictions, they are liberations. They free you from the tyranny of momentary feelings and anchor you to long-term logic. Discipline is not the absence of emotion, it is the architecture that contains it. The final truth: you will never eliminate emotion from investing. Nor should you. Emotions signal values, they tell you what matters. The goal is not suppression, it is channeling. Use fear to reinforce risk management. Use greed to fuel discipline saving. Use regret to improve your process. But never let them drive your trades. Build systems that make emotion irrelevant to execution. Because in the end, the market does not remember how you felt. It only records what you did. And what you did, not what you felt, determines your results. Investing without a written plan is like building a house without blueprints. You might end up with something that stands, but it will not be efficient, safe, or aligned with your needs. Yet most investors operate exactly this way, reacting to tips, trends, or temporary emotions instead of following a documented, measurable strategy. A real investment plan is not a vague goal like get rich or retire early. It is a specific, time-bound, risk-calibrated roadmap that answers: what are you investing for? How much do you need? By when? And what are you willing to risk to get there? The first pillar of any investment plan is defining your objectives with precision. Wealth building is too broad. Is your goal to generate 10,000 reais per month in passive income by age 50? To preserve 2 million reais in purchasing power over 30 years? To fund a child's education in 12 years? Each objective demands a different strategy, asset allocation, and risk profile. Without this clarity, you are not investing, you are gambling with purpose. And purposeless capital is easily lost. Time horizon is non-negotiable. A 25-year-old saving for retirement can afford to ride out volatility and hold high-growth, high-risk assets. A 60-year-old needing income in 2 years cannot. Yet many investors ignore this, chasing short-term performance regardless of their actual timeline. This mismatch leads to panic during downturns and missed opportunities during recoveries. Your time horizon dictates your risk capacity, not your risk appetite. You might feel comfortable with crypto at 65, but your financial reality says otherwise. Align strategy with math, not mood. Risk tolerance must be quantified, not guessed. Most investors say they are moderate risk takers until they lose 10%, then they panic. Real risk tolerance is measured by how much drawdown you can endure without changing your behavior. If a 20% drop makes you sell everything, your risk tolerance is low, regardless of what you claim. Use historical simulations. Stress test your portfolio. Ask, if this drops 30% next month, will I hold, buy more, or sell? Your honest answer defines your true risk profile and should dictate your asset allocation. Asset allocation is the single most important decision in your plan, more than stock picking, market timing, or fund selection. It determines roughly 90% of your long-term returns and volatility. Yet most investors treat it as an afterthought, piling into hot assets without considering how they interact. A proper allocation balances growth assets, equities, real estate, alternatives with stability assets, bonds, cash, inflation hedges, based on your goals, timeline, and risk tolerance. Rebalance regularly, not when you feel like it, but when allocations drift beyond predefined bands. Position sizing rules prevent catastrophe. Even the best investors are wrong often. What separates them from amateurs is how much they lose when they are wrong. Never allocate more than a fixed percentage of your portfolio to any single position. 5% is a common institutional rule. This is not about limiting upside. It is about ensuring no single failure can derail your entire plan. Concentration feels like conviction. In reality, it is unmanaged risk disguised as confidence. Liquidity planning is ignored until it is too late. Investors lock money into illiquid assets, private equity, long-term bonds, restricted stocks, without reserving enough cash or liquid instruments to cover emergencies, tax bills, or tactical opportunities. When forced to sell during downturns to raise cash, they crystallize losses and break their strategy. Always maintain a liquidity buffer, 6 to 12 months of expenses in cash or near-cash instruments, separate from your investment portfolio. This is not idle money, it is strategic insurance. Tax efficiency must be engineered into the plan from day one. Holding periods, account types, taxable versus tax-deferred, asset location, bonds and tax-advantaged, equities and taxable, and harvesting strategies all dramatically impact net returns. Investors who ignore taxes are gifting returns to the government. Work with a tax-aware advisor or use software to model the after-tax impact of every decision. Pre-tax returns are vanity. After-tax returns are sanity. Your plan must include review and adaptation protocols, not open-ended discretion. Schedule quarterly reviews to assess performance versus benchmarks, rebalance allocations, and reassess goals. But do not allow emotional tinkering. Changes should only occur if your goals, timeline, or risk profile have materially shifted, not because the market moved. Discipline means following the plan even when you do not like it. Especially when you do not like it. Finally, write it down. A plan that exists only in your head is not a plan, it is a hope. Document every element, objectives, timelines, risk parameters, allocation rules, rebalancing triggers, tax strategies, and emergency protocols. Sign it, date it, revisit it. Share it with a trusted advisor or accountability partner. The act of writing transforms vague intentions into enforceable commitments. And in investing, commitment, not cleverness, is what compounds over time. Performance chasing is the single most common and most costly behavioral error in investing. It is the tendency to buy assets after they have gone up and sell them after they have gone down, based on recent returns rather than fundamentals. This is not speculation, it is statistical self-sabotage. By the time an asset class or fund appears on top performers lists, much of the easy gain is already priced in. Buying then means paying peak prices for past performance, not future potential. The crowd is not a compass, it is a lagging indicator. When everyone is piling into AI stocks, crypto, or real estate, it is not a signal to join, it is a warning that sentiment is overheated. Crowds amplify trends until they break. The most dangerous moment in any market cycle is when everyone agrees. That is not consensus, it is complacency. And complacency precedes corrections. Following the crowd does not make you safe, it makes you late. And in markets, being late is expensive. Fund flows data proves this relentlessly. Billions pour into equity funds after multi-year rallies, just before corrections. Billions flee to bonds or cash after prolonged bear markets, just before recoveries. Investors systematically buy high and sell low, not because they are foolish, but because they are human. They extrapolate recent trends into the future, assuming that what went up will keep going up. Markets do not work that way. They mean revert. They rotate. They punish momentum worshippers. Media and marketing feed this cycle. Top 10 funds of the year. This stock gained 300%. By now, these headlines are not analysis. They are clickbait designed to trigger FOMO. And they work. Investors see past returns, assume they are predictive, and deploy capital, often at the worst possible time. Past performance is not just no guarantee of future results. It is often inversely correlated with future results, especially after extreme moves. The hotter the performance, the colder the future returns tend to be. The antidote is contrarian discipline, not for the sake of being different, but for the sake of being early. When an asset class is universally hated, undervalued, and underowned, that is when opportunity builds. When it is universally loved, overvalued, and overcrowded, that is when risk builds. This is not market timing, it is valuation awareness. Use metrics like PE ratios, CAPE, yield spreads, and sentiment surveys to gauge where you are in the cycle. Do not guess. Measure. Build rules that force you to buy when others are fearful, not because it feels good, but because your plan demands it. Automate dollar cost averaging into broad indices regardless of headlines. Set rebalancing triggers that force you to sell overperforming assets and buy underperforming ones, mechanically without emotion. This is not exciting. It does not make headlines. But over decades, it crushes performance chasers. Boring discipline beats exciting timing, every time. Avoid story stocks, assets driven by narrative rather than fundamentals. Meme stocks, crypto narratives, disruptor hype. These are casinos disguised as investments. They do not generate cash flow. They do not have earnings. Their value is based entirely on the greater fool theory, the belief that someone else will pay more later. When the story fades, and it always does, the price collapses. And the crowd that cheered the rise is nowhere to be found on the way down. Track your own behavior. How often do you check your portfolio when markets are up versus down? Do you research more when you are winning or losing? Do you talk more about your wins or your losses? These patterns reveal whether you are chasing performance or following a plan. Awareness is the first step to correction. Journal your emotional triggers. Note when you feel the urge to do something because the crowd is doing it. Then wait 72 hours. Most urges expire. Diversify across uncorrelated strategies, not just assets. Trend following, value, quality, carry, defensive. Different strategies perform in different environments. If you are only invested in what is working now, you are setting yourself up for pain when the cycle turns. Allocate to strategies that feel uncomfortable today, because they will likely be essential tomorrow. The goal is not to win every quarter, it is to survive every environment. Finally, redefine success. Stop comparing your returns to last year's hottest fund or your friend's crypto win. Compare your returns to your plan's objectives. Did you stay within risk limits? Did you rebalance? Did you avoid emotional trades? That is real success. Performance chasing is a treadmill. You run faster and faster but never arrive. Strategic discipline is a staircase, slow, steady, and cumulative. Choose the staircase. Ignore the crowd. Let them chase. You compound. Fees are silent wealth killers. They do not show up in headlines. They do not trigger panic. But over time, they devour returns with ruthless efficiency. A 2% annual fee does not sound like much, until you realize it can consume 40% or more of your total returns over 30 years. Most investors focus on gross returns, what the fund or stock did, while ignoring net returns, what they actually kept after fees, taxes, and costs. That is like celebrating a salary raise while ignoring inflation. Real wealth is measured after friction, not before. Expense ratios are just the beginning. Mutual funds and ETFs charge management fees. Brokers charge commissions. Advisors charge AUM fees. Platforms charge custody fees. Hidden fees include 12b-1 fees, load fees, redemption fees, and bid-ask spreads. Most investors do not read the fine print, and that is exactly how fees accumulate unnoticed. Always demand full fee transparency. Calculate total cost of ownership before investing. If you cannot explain every fee in plain language, do not invest. Actively managed funds are the worst offenders. The average actively managed equity fund charges 0.7 to 1.5% annually, and that is before trading costs, which can add another 0.5 to 1%. Meanwhile, 85 to 90% of them underperform their benchmark over 10 years. You are not just paying for underperformance, you are paying extra to lose. Index funds and ETFs with fees below 0.10% are not cheap, they are rational. Paying more for active management is only justifiable if you have evidence, not hope, that the manager adds value after all costs. Taxes are the largest expense most investors will ever pay, and the most avoidable. Short-term capital gains are taxed as ordinary income, up to 37% federally in the United States, plus state taxes. Long-term gains are taxed at 0 to 20%. Yet many investors trade frequently, triggering short-term rates unnecessarily. Others fail to harvest losses to offset gains. Others hold tax-inefficient assets, like bonds or REITs, in taxable accounts instead of tax-advantaged ones. This is not complexity, it is negligence. Tax efficiency is not optional, it is foundational. Asset location is as important as asset allocation. Hold tax-inefficient assets, bonds, dividend stocks, REITs in tax-deferred accounts, IRAs, 401ks. Hold tax-efficient assets, growth stocks, ETFs with low turnover in taxable accounts. Municipal bonds in taxable accounts for high earners. This simple structuring can add 0.5 to 1.5% annually to after-tax returns, with zero additional risk. Most investors ignore this and pay the price for decades. Turnover kills. Every trade has a cost, commissions, even if free, there is spread and slippage, taxes, and opportunity cost. High turnover strategies, whether yours or your funds, bleed capital through friction. Low turnover, buy and hold strategies compound cleanly. The best investors are not the ones who trade the most, they are the ones who trade the least. Warren Buffett's favorite holding period? Forever. Not because he is lazy, because he understands cost drag. Beware of free trading. Zero commission brokers make money elsewhere, payment for order flow, margin lending, premium subscriptions. And free does not mean costless. The bid-ask spread is a hidden tax, especially on low volume or volatile assets. Slippage, the difference between expected price and execution price, can be massive during volatility. Always check execution quality, not just headline fees. Free trades can be the most expensive of all. Use tax loss harvesting strategically, but not emotionally. Selling losers to offset gains is smart tax management. Selling winners to avoid taxes is behavioral sabotage. Never let the tax tail wag the investment dog. Pay taxes when necessary, it means you made money. The goal is to minimize taxes, not avoid them at the cost of your strategy. Harvest losses systematically, not as an excuse to abandon positions you still believe in. Audit your costs annually. List every fee, every tax payment, every commission. Calculate them as a percentage of your portfolio. Compare to low-cost benchmarks. If your total cost drag exceeds 1% annually without delivering alpha, you are being inefficient. Renegotiate, switch providers, simplify. Costs are the one variable you can fully control. Do not outsource that control to brokers or fund managers who profit from your ignorance. Remember, in investing, returns are uncertain. Costs are guaranteed. You cannot predict the market, but you can predict exactly how much you will pay in fees and taxes if you do not manage them. The path to wealth is not about finding the highest returning asset. It is about keeping the most of what you earn. Minimize friction. Maximize retention. Let compounding do the rest. Small savings today become massive differences tomorrow. Control what you can, and you can control costs. Diversification is not just owning a lot of stocks. It is the strategic allocation of capital across uncorrelated risk factors to reduce portfolio volatility without sacrificing long-term return. Most investors think they are diversified because they own 20 stocks, but if all 20 are United States tech companies, they are not diversified. They are concentrated. True diversification spans asset classes, geographies, sectors, factors, and time horizons. It is not about safety, it is about resilience. Correlation is the key, not quantity. Two assets that move together 90% of the time offer almost no diversification benefit, even if they are in different sectors. What you want are assets that zig when others zag, not perfectly, but enough to smooth the ride. Bonds historically zig when stocks zag. Commodities sometimes zig during inflation. Alternatives like managed futures or market-neutral strategies can zig during crises. Find the zags and allocate to them deliberately. Geographic diversification is ignored by most retail investors. Over 50% of global market cap exists outside the United States, yet United States investors typically allocate less than 15% internationally. This home bias is emotional, not rational. It assumes your home market is safer or better, when in reality it is just more familiar. Familiarity is not a risk management strategy. Allocate globally, developed and emerging, based on market weight or strategic tilt, not comfort. Factor diversification matters. Stocks are not just stocks. Some are value, some are growth, some are small cap, some are quality, some are low volatility. These factors perform differently in different cycles. A portfolio tilted only to growth and momentum will crush during bull markets and collapse during corrections. Blend factors intentionally. Rotate systematically, not emotionally. Factor diversification smooths returns across economic regimes. Alternative assets are not extras. They are stabilizers. Private real estate, infrastructure, commodities, managed futures, market-neutral funds, these are not for chasing returns. They are for reducing correlation to traditional stocks and bonds. Even a 10 to 20% allocation to true alternatives can dramatically reduce portfolio drawdowns during crises without sacrificing long-term growth. Most investors ignore them because they are complex or illiquid. That is a mistake. Complexity can be managed. Risk cannot. Time diversification, or dollar-cost averaging, is the most underutilized tool. Investing lump sums feels powerful, but it is statistically riskier. Markets can drop 20% the day after you invest. DCA smooths entry points, reduces timing risk, and enforces discipline. It is not about maximizing returns, it is about minimizing regret. And in behavioral terms, minimizing regret is what keeps investors in the game long enough to win. Rebalancing is diversification maintenance. Left alone, portfolios drift. Winners grow. Losers shrink. What started as a 60-40 portfolio becomes 80-20 after a bull run, exposing you to more risk than you intended. Rebalancing forces you to sell high and buy low, mechanically, without emotion. Do it quarterly or when allocations drift beyond 5 to 10% bands. It is not market timing, it is risk control. And it adds 0.5 to 1% annually to returns over time. Avoid diversification, adding assets that look different but behave the same. Owning 50 S&P 500 ETFs is not diversification, it is redundancy. Owning 10 crypto tokens is not diversification, it is concentration in a single speculative theme. Diversification requires true independence of return drivers. If everything in your portfolio goes down together during a crisis, you are not diversified, you are exposed. Audit correlations. Stress test together. Simplify ruthlessly. Liquidity is part of diversification. Do not lock all your capital in illiquid assets, private equity, venture, long-term bonds without maintaining dry powder. When opportunities arise or emergencies hit, you need optionality. Keep 5 to 15% in cash or short-term instruments, depending on your needs. This is not idle money, it is strategic flexibility. The ability to act when others cannot is a form of diversification too. Finally, diversification is not about avoiding loss, it is about surviving to compound. No portfolio avoids drawdowns, but a well-diversified portfolio ensures drawdowns are survivable, not catastrophic. It lets you stay invested through cycles instead of bailing out at the bottom. And staying invested, not timing, not stock picking, is what generates 90% of long-term wealth. Diversify not to win more, but to lose less. And in investing, losing less is how you win most. Most investors confuse risk with volatility, and that misunderstanding costs them dearly. Volatility is short-term price fluctuation. Risk is the permanent loss of capital. A stock that swings 5% daily is not necessarily risky if its fundamentals are strong and its long-term trajectory is up. A stable stock that slowly bleeds value due to declining earnings is highly risky, even if its price barely moves. Volatility is noise. Risk is damage. Learn to distinguish them, or you will panic at the wrong things and ignore the real threats. Volatility is not your enemy. It is your opportunity. Markets fluctuate. That is not a bug. It is a feature. Volatility creates mispricings, creates entry points. It separates emotional traders from disciplined ones. Investors who flee volatility guarantee underperformance, because they exit when prices are low and re-enter when prices are high. Embrace volatility as the cost of admission for higher returns. Do not fear it, manage it. Use it. Profit from it. Real risk comes in many forms, and most are invisible until it is too late. Business risk, the company goes bankrupt. Inflation risk, your returns do not keep up with rising prices. Liquidity risk, you cannot sell when you need to. Concentration risk, one failure wipes you out. Longevity risk, you outlive your money. Sequence of returns risk, you retire into a bear market. These are the risks that destroy portfolios, not daily price swings. Map them, measure them, mitigate them. Standard deviation, the common risk metric, is dangerously misleading. It measures volatility, not risk. A fund with low standard deviation can still blow up if it is leveraged or exposed to hidden tail risks, like LTCM in 1998. A volatile fund with strong fundamentals and low leverage can be safer long-term. Stop using volatility as a proxy for safety. Start asking, what can permanently impair my capital? That is the risk that matters. Drawdowns are inevitable. Every portfolio will lose value, sometimes 20%, sometimes 50%. The question is not how to avoid drawdowns. It is how to survive them. Survival depends on three things: liquidity, do not force sales; time horizon, do not need the money soon; and psychology, do not panic. If you are invested in quality assets with long-term growth potential, drawdowns are temporary. Panic is permanent. Structure your portfolio so you can endure the storm, not flee it. Risk capacity is not equal to risk tolerance. Risk capacity is what you can afford to lose based on your goals and timeline. A 25-year-old has high risk capacity. A 70-year-old retiree has low risk capacity. Risk tolerance is what you are emotionally willing to endure. Many investors have high tolerance but low capacity. They feel fine with risk until they need the money. Align your portfolio with capacity, not tolerance. Emotions lie. Math does not. Tail risk hedging is not paranoia. It is prudence. Extreme events, pandemics, wars, financial crises, happen more often than models predict. A small allocation, 1 to 3%, to tail risk hedges, long volatility, put options, gold, managed futures, can protect your portfolio during black swans without dragging long-term returns. It is insurance, not investment. Pay the premium. Sleep better. Survive the crash. Inflation is the silent risk most ignore. Stable cash and bonds lose purchasing power over time. If your portfolio returns 5% but inflation is 3%, your real return is 2%. If inflation spikes to 8%, you are losing ground, even if your statement shows gains. Allocate to real assets, equities, real estate, commodities. Tips: do not chase yield in nominal terms. Preserve purchasing power in real terms. Inflation does not show up on price charts, but it hollows out your wealth. Leverage magnifies risk, not returns. Borrowing to invest turns volatility into catastrophe. A 20% drop with 2 times leverage equals 40% loss and a margin call. Leverage does not make you smarter. It makes you fragile. Avoid it unless you fully understand the math, the triggers, and the exit. Even then, most professionals blow up using leverage. You do not need it to build wealth. Compounding does that just fine without the cliff edge. Finally, redefine risk. Risk is not losing money this quarter. Risk is failing to achieve your long-term goals. Risk is outliving your assets. Risk is needing money during a bear market. Build your portfolio to mitigate those risks, not to minimize short-term fluctuations. Accept volatility as the price of growth. Manage real risk with structure, diversification, and discipline. Because in the end, the biggest risk is not the market, it is misunderstanding what risk actually is. Patience is not a virtue in investing, it is the core operating system. Wealth is not built in quarters. It is built in decades. Yet most investors operate on emotional timeframes, reacting to daily charts, quarterly earnings, or annual rankings. This mismatch between biological impatience and financial reality is why 90% of investors underperform. Compounding requires time, uninterrupted, undisturbed, unemotional time. Interrupt it with panic, tinkering, or performance chasing, and you break the machine. The market's greatest gift is long-term compounding, and its greatest test is forcing you to wait for it. Returns are not linear. They come in unpredictable bursts, often after long periods of boredom or pain. Investors who bail during the waiting phase miss the harvest phase. The S&P 500's best 10 days over 20 years accounted for over 50% of total returns. Miss those days because you were waiting for a better entry, and you have your wealth. Time in the market beats timing the market, always. Short-termism is amplified by technology. Apps show real-time P&L. News cycles scream urgency. Social media flaunts instant wins. This creates the illusion that investing is a sprint, when it is a marathon with no finish line. The most successful investors are not the smartest or the fastest, they are the most patient. They ignore quarterly noise. They do not check portfolios daily. They measure progress in 5-year increments, not 5-minute charts. Career risk drives impatience. Fund managers chase quarterly performance to keep their jobs. Retail investors chase monthly gains to prove they are good at this. But real investing is not about proving anything, it is about achieving objectives. If your goal is 30-year wealth, why measure success in 30-day increments? Align your review cycles with your time horizon. Check annually, not daily. Adjust strategy every 3 to 5 years, not every headline. Boredom is a sign of health, not failure. A portfolio that does not move much, does not make headlines, and does not trigger dopamine is often the one compounding quietly in the background. Excitement in investing is usually a warning sign. It means someone is taking unsustainable risk. Seek boredom. Celebrate consistency. Let others chase fireworks. You compound in silence. Avoid strategy hopping. Jumping from value to growth to crypto to dividends every 12 months guarantees you will buy high and sell low, and pay taxes and fees along the way. Strategies need time to work. Value underperforms for years, then crushes. Momentum runs hot, then crashes. Buy and hold bores, then outperforms. Stick to your strategy through its full cycle. If you abandon it every time it underperforms, you will never capture its upside. Automate patience. Set up automatic contributions. Automatic rebalancing. Automatic dividend reinvestment. Remove yourself from the decision loop. You cannot panic sell if the trade is not in your hands. You cannot FOMO buy if the money is already allocated. Systems enforce patience better than willpower ever can. Build systems that make waiting effortless because effortful waiting always fails. Measure what matters. Not this month's return, but your progress toward your 10-year goal. Not your neighbor's crypto win, but your risk-adjusted, tax-efficient, inflation-beating net worth growth. Not the S&P's daily move, but your personal funded ratio, assets divided by liabilities. Shift your metrics from external noise to internal purpose. Purpose sustains patience. Noise destroys it. Legacy is greater than performance. The goal is not to die with the highest IRR. It is to live with financial peace and leave something meaningful behind. Patient investors build legacies. Impatient investors leave lessons. Teach your children patience. Document your philosophy. Build a portfolio that outlives you, not one that dies with the next market fad. Long-term perspective is not about numbers, it is about meaning. Final CTA, if this resonated, you are already ahead of 90% of investors. But knowledge without action is entertainment. Open a document right now. Write your investment plan, goals, timeline, risk rules, allocation, rebalancing schedule. Sign it. Date it. Review it annually. Ignore the noise. Execute the plan. And if you found value here, do 3 things like this video, it helps the algorithm. Subscribe because we publish deep, no-fluff finance content every week. Comment plan first below. to hold yourself accountable and join a community of disciplined investors. Wealth is not built in moments. It is built in decades. Start your decade today.